that, we want to bring in Victoria Fernandez, Crossmark, a global investments chief market strategist. So Victoria, help us make sense of what Jared was just explaining, all the scenarios here, the hawkish rhetoric from Fed Chair Jay Powell, the most realistic, you think, or most likely scenario at this point in terms of a hard landing, no landing, or soft landing. What do you think?
Yeah, so Seana, we're really looking at having a mild recession later this year. Originally, or back at the beginning of this year, just 2 months ago, we would have said that probably happens around the middle of the year because we would have anticipated that the Fed would stop raising rates probably after the March meeting, maybe the May meeting, and then go on pause. As we've seen as of late, all of those expectations have been pushed higher and further out on the calendar. So we do anticipate to probably see a terminal rate probably around 5.5 to 5 3/4, and we expect that to lead us into a recession later in 2023, third or fourth quarter, expecting no rate cuts this year at all. For us, that means there's going to be continued volatility in these markets. The Fed does not have their playbook etched in stone at this point, so it's a battle as to what they're going to do going forward. The bar was raised or lowered a little bit after Powell yesterday, opening that door for a 50 basis point move. But I think so much is going to depend on the labor report this week and on the CPI numbers next week before we can really take a better guess at what March holds.
And what about inflation? Do you see it getting back to 2% or see Powell settling for something around 3 plus?
You know, this is the huge question that we have when we talk about having a recession later this year. The one thing that we say can prove us wrong, and we wouldn't mind being wrong on saying that there's a recession, what could change that is the Fed pausing sooner rather than later, saying, you know what, a 3 handle on inflation is something we can deal with. Let's get to that point and let's stop. For right now, Powell is saying that is not going to happen. They are steadfast to get to that 2%. If they push to get to 2%, then I think we definitely go into a recession, and maybe it's more than a mild recession. But let's look at some of the data we just got this week. Used car prices, Manheim came out with their used car prices up 4.3% month over month in February. That number was down 2% in the January CPI report. So I'm telling you that when we look at these services numbers and these core numbers, some of the underlying elements, it's telling us we are not in a permanent disinflationary environment. We're going to see some of these pricing and these inflationary pressures continue to go higher. The strong labor market, wages, rents, all of these things that eventually will cool off. I don't think it's going to be imminent. So I think we need to be watching for higher CPI numbers that will push the Fed even further.
Victoria, you say eventually. There were several questions from both sides of the aisle today about the Fed using lagging versus leading indicators. Does that concern you at all, in particular when it comes to rent?
Well, there's a lot of elements in the market that do have that lagging effect, and even rate hikes themselves have that lagging effect. You know, we hear people say that it's 6 to 9 months. Some people say 9 to 12 months before a rate hike actually works through the economy, which is one of the reasons that I think the Fed will be cautious in going 50 basis points at the March meeting. We've still got 450 basis points worth of hikes that need to work through the economy from a year ago. So I think that, yes, there's lagging things that need to work through. Rents is one of those, and I understand that. But you look at leading economic indicators, those have been down 10 months in a row. So I think you get it from both sides, leading indicators and lagging indicators. There's some concern on both sides of that. So obviously, take the lagging ones with a little bit of a grain of salt in the fact that it's going to take longer to see those work through the economy. But the Fed knows that, and they're paying attention to that.
Victoria, you have a list of stocks that you like and stocks to avoid in this environment. Let's start with the ones that you trust. You have a group of consumer staple names, also healthcare names, and consumer spending. What are they and why?
Yeah, so we think because we think our outlook is the way it is, and there's going to be a lot of volatility in this market. You need to have some exposure to some staples, defensive names, and some cyclical names to take advantage of some of the upside that we'll get in bits and pieces. So you look at a name like a Lowe's, you look at a name like a General Mills. These are good staple names in your portfolio. Yes, they have some exposure to the consumer, and the consumer has been quite strong. Their balance sheets are strong on the consumer side, and their corporate balance sheets for these names are strong as well. So we think those are good additions. We also like healthcare, the HMOs. And I know people will say, why? These have been hammered this year, but that's part of our thesis. They have underperformed. They're now priced cheap relative to the rest of the market, but they do have above average growth, and their earnings were pretty decent. So if we can get a stock that has a good balance sheet, good growth at a cheaper valuation, then we think names like a Cigna or an Elevance Health are good options. And finally, we like credit cards. MasterCard and Visa are names we like, but they're a little rich right now, Seana. So I would say maybe put those on your wish list. See if those valuations come down a little bit more, then you can add those.
You speak of consumer spending. One thing they are spending on at record rates is travel, but you are actually not all in on the sector. What are some names and why?
Yeah, so I think actually you look at airlines, you look at hotels. These are sectors that we would probably start avoiding or at least trimming. Airlines were up yesterday on the news on the JetBlue Spirit merger. And so I think you could trim a little bit of those names. We have seen tremendous demand there. And I'm not saying it stops completely, but I think we're going to start to plateau a little bit there. And especially if we go into a recession at the end of this year, those discretionary trips are going to be the things that get pulled back first. We're actually short Choice Hotels and American Airlines. So we think there's some definite downside to these sectors going forward for the rest of the year. We would be cautious there.
All right, Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Thanks so much.